welcome to Debt Free in 30, where every week we take 30 minutes and talk to industry experts about debt, money, and personal finance. I'm Doug Hoyes. It's the end of the month, so that means it's time for another frequently asked questions show here on Debt Free in 30. Today we're going to get the answers to a series of frequently asked questions that deal with the cost of bankruptcy. You might think, well, what's to talk about? You're bankrupt. You have no money. How can it cost anything? Well, it's not that simple, so to discuss it, I'm joined once again by my Hoyes Michalos co-founder, Ted Michalos. So, Ted, are you ready to talk about money?
Let's give it a shot.
Okay, so before we talk about what it costs to go bankrupt, let's start with a more fundamental question. Why does it cost money to go bankrupt? The reason you're going bankrupt is you have so much debt that you can't pay it. So why does it cost money to go bankrupt?
I'm not sure I even accept that premise that it costs money. It actually saves you money to file bankruptcy. And I know that sounds a little crazy, but if you are the average person and owe $50,000 worth of debt, your minimum payments every month are about $1,500. And so by filing bankruptcy, you're going to reduce that $1,500 payment to an administrative fee, to basically the costs of processing the paper to eliminate the debt. So I don't know that I accept the premise that it costs money to file bankruptcy. I think it saves you money. It solves a serious problem for people.
Okay, so, and that makes perfect sense. In terms of me being the person who has the debt, and I come in to see you and we decide that after looking at all the options, a bankruptcy is something that I have to do, what am I going to have to pay each month? Because there is a cost to doing it. There is a payment I'm going to make.
There is definitely a payment. The cost is going to be based on your family situation. So how much money is coming into the household, how many people are dependent on that money, and what assets, what things do you own that might have worth. Now, the last part usually scares people, but there are lots of protections under the law. Nobody's going to come to your home, clean out all your furniture, make you sell your car, make you sell your house. We're going to look to see, is there cash available there that your creditors might be legally entitled to? And then we're going to find a payment plan to deal with it.
Okay, so you hit on a few different points there, so let's kind of break them down. So if I go bankrupt, there is stuff that I own that I'm potentially going to lose. That's what you're talking about.
That's the way the law works, but the truth is very few people ever lose anything. There are exemptions under the law that protect your furniture, your personal possessions, musical instruments, sports equipment, cars. So most people that have to file bankruptcy aren't looking at losing anything. There's still a cost associated with the bankruptcy. You got to make a payment based on your family income and size, but it's rare that somebody loses something in a bankruptcy.
Okay, so let's break it down. We'll talk about the whole family size and income in a minute. So assets. So if I own a house, are you going to take that away from me?
So if you own a house, and if the house was sold, there'd be any money left over, you're going to have to pay an amount equal to that into a bankruptcy. So let's do some rough numbers. Let's say your house is worth $200,000. Your mortgage is $180,000. Well, if your house is sold, there's no money left for anyone once the real estate and legal fees are paid, and so your house is not going to be affected by the bankruptcy. You got to keep making your mortgage payments, you got to pay your property taxes, you got to pay your utilities, but the bankruptcy is not going to affect your house. Change the example now, and instead of having a $180,000 mortgage, maybe your mortgage is $160,000. So now the $200,000 house, we subtract the mortgage, all the closing costs, you probably have $20,000 in equity in that house. So if you filed bankruptcy, that $20,000 is going to have to be dealt with. But frankly, people in that situation, we counsel them to file a consumer proposal. And that's probably a topic for another show.
Well, and we'll talk about consumer proposals maybe in the second segment. But what you're saying is when someone comes in to decide whether they're going bankrupt, you're going to take a look at the different assets that they own and figure out if they have any realizable value. So the example of the house is a pretty common one. If you sold the house, how much would you get?
That's exactly right.
And is it the same with a car?
Well, so cars, if your car is financed, you're going to have to keep making payments to the finance company, to the bank that's got it, the car company, whomever it is that loaned you the money in the first place. Unless the car can be sold and there's more than $5,600 available, nobody's going to touch your car because that money is yours by right. So another way of saying that is, if your ownership interest in the car is worth less than $5,600, then your car's safe in a bankruptcy. And in, I got to say, 99.9% of all bankruptcies now, cars are not a factor.
Yeah, because if it's financed, then there's almost certainly no equity in it.
That's right. And the finance company doesn't want it back because they'll lose money. All they want you to do is keep making your payments.
So two questions there then. If you own a car if you have a car that's financed, either it's a lease or a loan, you can continue making the payments and keep the car even if you're bankrupt.
Correct.
Now, the second point you said was $5,650. What are you talking about there?
Yeah, so remember I briefly mentioned that there are exemptions. Your assets are protected under the law depending on what type of asset they are. In Ontario, where I live, there's a level of, a threshold of $5,650 if your car is worth that or less, or your interest in the car is worth or less. It's protected under the law. Nobody can take it from you.
And so if the car is worth $5,000, you get to keep it.
Yeah.
If you have a car that's worth $10,000 and there's a $6,000 loan against it, then the equity is $4,000. That's less than $5,000. You get to keep it as well in that scenario.
Correct. So, again, that's right.
And what we're talking about here is Ontario law. So if you happen to be listening to this podcast somewhere else in the country, the numbers may be slightly different. But okay, so we're getting back to this whole, what does it cost to go bankrupt? So the first cost we've talked about is you lose some of your assets. So if there's equity in your house, potentially you lose that. If there's equity in your car, potentially you lose that. What other assets would you typically be taking from someone?
Well, the most common thing that people have next is an RRSP. And RRSPs have got great protection under the law. If you haven't made a contribution to your RRSP in the last 12 months, nobody can touch it. I mean, the government's decided that they want you to invest in your retirement, to save money for later in your life. And so now it's protected under bankruptcy law. The only money that's not protected is money that you put in the last 12 months. They did that basically because they don't want people playing a game, opening an RSP the day before bankruptcy and putting all their life savings into it.
Which makes sense. And often if you're in financial trouble, you can see it coming. So one of the first things you do is stop contributing to your RSP. So it's pretty common by the time you get to the bankruptcy that you haven't been contributing for the last year anyways.
Well, there's a worse side effect of that too, though. Often when people get in financial trouble, the first thing they do is start cashing out their RSPs. And if they were aware of the law, they'd probably come to talk to somebody like you or I sooner, and that money would still be there for them in the future, as opposed to cashing it out to give to a credit card or a line of credit and then having to come see me anyway.
Well, and so you raise a good point then, that when you're in financial trouble, it's good to get some actual professional advice, because cashing in your RSP not only is going to increase your taxes potentially, but you're also getting rid of something that you could have perhaps kept in the future. So, and then tax returns, how does that work?
Well, so if you're entitled to a tax refund for the year you file bankruptcy or any year previous, you'll lose it in the bankruptcy. So depending on the time of year that you're filing, you may actually want to wait for a little bit, a couple of weeks, to get your tax refund before you start. You're going to lose 1 year's tax refund in a bankruptcy no matter what you do. And the only way you can justify that is saying, okay, so yes, I'm losing my tax refund, but I'm eliminating $20,000, $30,000, $40,000 worth of debt. It's the cost of doing business.
And in most cases, if you hadn't gone bankrupt, you would have used your tax refund to pay off your creditors anyway, so it's kind of money that's gone. So the final topic then in this what does it cost to go bankruptcy discussion is what you mentioned earlier, that it's based somehow on your income and the size of your family. So what you're talking about there is surplus income. Walk us through what you're talking about there. How does that work?
Yeah, this part of bankruptcy law confuses a lot of people, and it's not supposed to be intimidating. The concept is simple. The government has set thresholds. They set limits for what they think families of different sizes need to have for a reasonable standard of living. So, for example, a single person, the government thinks you need around $2,000 of take-home pay to live on. So in a bankruptcy, every month we look to see how many people are in the family, how many people you're supporting, and that's a little different. So if you got kids in university and they're still coming home and raiding the fridge, they're probably still part of your family. And how much money is coming in. And we compare that to the government guideline. If you're over the government guideline, there are additional payments due into the bankruptcy. If you're under the government guideline, there are not.
And it kind of makes sense. The more money you make, the more you have to kick into the pot for your creditors. That's really what the concept is.
Well, and it's even more basic than that. The government has decided that if you're over their threshold for what they think a family your size needs, you keep half, your creditors get the other half.
Makes sense. So the answer to the question then about the cost of bankruptcy, number one, you lose some of your assets, but as you've said, in most cases, that's really not a factor because most people who are going bankrupt don't have a whole lot of assets. Number two, you have this surplus income payment that you have to make. The more money you make, the more you have to pay. And then in a lot of cases, there is a minimum contribution that you're going to make as well to cover the administrative costs if there are no other funds available. The
government basically has stated, this is not law, but they've stated they expect expect the minimum contribution to be around $1,800. They think if a trustee's charging that or less, that it's a reasonable number.
So in a typical bankruptcy, even if you don't have any surplus income or any other assets, you're probably going to end up paying something like $200 a month for 9 months.
Probably.
Okay, well, one of the other questions we get asked a lot is how much do you get paid? But before we answer that, we're going to take a quick break and come back with that answer. You're listening to Debt Free in 30.
Looking for information on budgeting, debt consolidation, credit counseling, debt management, and debt settlement? For unbiased advice, go to moneyproblems.ca, the website for Canadians with money problems who want money solutions. moneyproblems.ca.
You're listening to Debt Free in 30. Here's your host, Doug Hoyes.
We're back here on Debt Free in 30. I'm Doug Hoyes, and my guest today is my Hoyes Michalos co-founder, Ted Michalos, and we're talking about the cost of bankruptcy. In the first segment, we talked about how the trustee does that calculation. It's based on how much income you earn, the size of your family, what you own. One of the questions that we often get asked is, okay, I get it, that's how much I have to pay, but how much do you guys get paid? How much do you as a trustee make when I go bankrupt? So explain how Rule 128 works, Ted. How does that all work?
Well, here's the first thing people need to understand. You're not actually paying a trustee a fee. What you're doing, whatever payments you're required to make into the bankruptcy goes into a trust account, which is why I'm called a trustee. And then at the end of the bankruptcy, depending on how much money is in there, it's proportioned out. Now, the first person who gets a payment out of that is actually the government, the filing fee allowing you to go to file the bankruptcy. The second person who gets paid out of that is the trustee, and it's based on a proportional formula. So the more money you've paid into your bankruptcy, probably the more money the trustee is getting paid, but conversely, they probably had to do more work, and there are limits. But the concept is you're paying money towards your debts. And then once we know how much money is in that pool, we break it out, we break it down to see who gets what piece of it.
And that's exactly how it works. And I think you made a key point there. The government gets the first chunk.
Exactly. Always.
That's always the way it works. And that's because bankruptcy is a legal process. It's governed by federal law. And the Office of the Superintendent of Bankruptcy, which is a subsection of Industry Canada, which is the federal government, they regulate everything we do.
That's right. They look after making sure that trustees are acting responsibly, that creditors are following the law, and that people who file bankruptcy are properly informed and properly perform their duties. They're a regulatory body.
And that's why they get the first chunk of money that comes out of the filing. And then the next chunk, as you said, goes to us. And so Rule 128 says, well, of the next money, the trustee gets the first $975, and then they get a percentage of the rest up to a certain limit, assuming it's a standard summary administration bankruptcy. That's how much a trustee gets paid. But your point, I guess, is the key one. It doesn't really matter how much we're getting paid. What matters is how much do I, as the person in debt, have to pay, and that should all be discussed with you way up front before you even file the bankruptcy.
Well, that's exactly right. If you don't know what your payment obligations are going to be, if it hasn't been explained to you, then I wouldn't be filing. I mean, it's a legal procedure, and surprises in a legal procedure are always bad. So you want to know how that monthly payment is going to be calculated, whether it's surplus income or an asset, or how it's going to be dealt with. You certainly don't want to get a letter 7 or 8 months into your bankruptcy saying, oh, by the way, you owe me this much money. I mean, that'll just drive you crazy.
Yeah, and there shouldn't be surprises because the rules are all set out by the government.
That's right.
We talked about surplus income in the first segment. The government says, here's how much you're allowed to make. If you make more, here's how much you got to pay.
Right.
So it shouldn't be that hard to do that math in advance. So, I mean, when it comes to surplus income, so every month you're sending the trustee your pay stub so they can do that math. What happens if you have a 3-pay month? Let's say I'm someone who gets paid biweekly, but twice a year there's a 3-pay month. Do I end up paying more then as a result of that?
Yeah. So what happens is, if you've never been bankrupt before, the first 6 months of your bankruptcy, you submit these statements, and in month 7, we average them. And the reason 6 months was picked because if you're paid biweekly or weekly, every 6 months you do get an extra paycheck. So the idea is, by reporting for 6 months, we get an honest picture of what half a year looks like for you. We then average those out and compare that to the government threshold. So if you have 1 month where you get an extra pay and it shoots you way over the guideline and you're thinking, oh no, I've lost half my paycheck, but you're under all the other months, probably when we average it out, you're going to be under overall. That's what happens in most cases.
And so it's not a big deal. Now, you also made the point that if I have a house that has a lot of equity, a bankruptcy isn't a good idea. You've just kind of made the point as well that if you are going to have a lot of surplus income, that means you're going to be paying a lot more in a bankruptcy. Maybe bankruptcy isn't a great option. You said it before, the option then to consider would be a consumer proposal. So we're going to talk about the cost of a consumer proposal, but let's start again with the basic question. What exactly is a consumer proposal?
So the idea behind a consumer proposal is you're offering your creditors a deal. You're going to repay a portion of what you owe. The catch is you've got to offer them more money than they'd get if you filed bankruptcy. Otherwise, they won't accept your deal. And you'll have to offer them enough to entice them to accept the deal. Right now, that means about 30 cents on the dollar in Canada.
So the cost of a consumer proposal is slightly more than the cost of a bankruptcy.
It always is, and that's because you're trying to convince the creditors that it's in their best interest to accept the deal.
So let's say I come into your office and we calculate this surplus income thing. I'm a single guy and I make around, $4,000 a month. So
you're doing pretty good.
I'm doing pretty good. I work a lot of hours though. I put in a lot of overtime. I work Saturdays and so on. So I am going to have to pay roughly how much a month in that scenario?
All right. So to keep this really simple, your take home is $4,000. Single guy. The government thinks you'll need $2,000 to live on. You're $2,000 over. Your payment would be $1,000 a month, and you'd be making those payments for 21 months. So bankruptcy costs you $21,000.
So a normal bankruptcy, if I don't have any surplus income, is 9 months. But if I'm over the limit, they add an extra year. That's where you're getting the 21 months to.
Right.
Okay. So I don't have $1,000 a month because I've got expenses. I realize I'm going to have to pay that. So I come to you and you say, well, why don't you file a consumer proposal instead? Okay, so give me a rough idea of what that's going to cost me then.
Well, so the big advantage of the consumer proposal is you can spread those payments over 60 months, 5 years. And so the first test we have is you've got to offer more than the bankruptcy. If the bankruptcy is $21,000, well, $21,000 over 5 years is $350 a month. So the bankruptcy is $1,000 a month for 21 months or $350 for the proposal for 5 years. Now there's a second test. You've got to repay at least 30% of the debt. So in this scenario, depending on how much money the fellow owes, you might end up paying more than the 21. So let's say that they owed $50,000, which is pretty typical of people that we see. 30% of $50,000 is $15,000. Well, the bankruptcy is worth 21. So in this case, he'd be repaying 21, $350 a month. And if you think about it, the minimum payments on $50,000 worth of debt is $1,500. So you're talking about not having to make a payment of $350. Don't think of it like a cost. It's you've taken your $1,500 a month payment and reduced it to $350. That's the way you really should be looking at these solutions.
Yeah, you've got to compare it to not zero.
Yeah, what happens if you do nothing?
Yeah, if I do nothing, I keep paying my $1,500 and I'm covering my minimum payments and a little bit. So I'm going to be paying for a lot more than 5 years.
Yeah, probably 20.
Probably 20. And so the proposal makes perfect sense. Now, you mentioned 30%. Is that in the law somewhere?
It isn't. So the Canadian banks have basically told the trustee community, they're looking for 30 cents on the dollar. And there's no logic to that. There are times when they will accept less. There are times when they ask for more. But it's a rough guideline that the industry uses now. And the rationale seems to be that if you're repaying less than 30%, they don't want to wait the 5 years for the money.
They might as well just write it off and be done with it.
Yeah, I don't get it, but they have to have some sort of standard. So, okay, we live with the standard that they've given us.
It makes no sense. And I know at our firm, we keep a very detailed list of every bank, every credit card company, every major creditor, because some of them are willing to accept a bit less. Some of them tend to be a little higher than what you're talking about, and that's where you're getting this, roughly 1/3 ratio from. So if you're sitting there going, well, I know how much I owe $60,000, and there's no way I could pay back $20,000 even over 5 years, it's still worthwhile to come in and talk to you, because if you have one of the creditors that perhaps is willing to accept a little less, it's worth it. But as a general guideline, that's where the numbers are.
Yep, you have to have something to start with.
And that's a good ballpark figure. So I asked you about bankruptcy, how much you get paid. How much do you get paid in a consumer proposal?
So in the proposal, the trustee receives 20% of whatever the total payments are. There's also an administrative fee, but it doesn't usually factor into anything, and you won't be charged that up front. It comes out of your payments.
So when you said that in the previous example, it was going to be $350 a month, so I'd end up paying like $400 a month then? Is that what you're talking about?
No. So you'd pay the $350. The money goes into a trust account. Again, you're dealing with a trustee, so we collect the money up, and every 6 months we pay it out to your creditors. When we pay it out to your creditors, they pay us a fee of 20% for handling the money. So in the example I just gave you, 6 times $350 is $2,100. The trustee's fee on that would be $420.
And I always love making Ted do the complicated math. So what if the payment was $423.16? Then how much would you make? So does the government get any money?
The government gets 5%. It's called a levy, and it's their administrative, it's them covering their costs for administering the program, for licensing trustees to monitoring things.
So in a proposal, the government gets 5%, the trustee gets 20%, roughly, and therefore the creditors are getting about 75%, and that's how they can do the math to decide if that's better for them than in a bankruptcy, because obviously in a bankruptcy they're not getting all the money either.
And so that's all good for people to know, but frankly, the average person doesn't need to get hung up on that. What you need to be thinking about is, these are my payments before I start. This is the payment I need to make in the proposal. This is the payment I have to make in the bankruptcy. And you figure out which one makes the most sense for you and your family.
That's a great way to summarize it, a great way to end it. Thanks very much for being here, Ted. We're going to take a quick break and come back to wrap it up here on Debt Free in 30.
What are the warning signs of debt problems? Where can I find a free online debt options calculator? Where can I get free ebooks and guides? Find all the answers at moneyproblems.ca, the website for Canadians with money problems who want money solutions. moneyproblems.ca.
Welcome back. It's time for the 30-second recap of what we discussed today. On today's show, Ted Michalos explained that the amount you pay if you go bankrupt depends on your income, family size, and your assets. In a consumer proposal, your payments will average around 30% of your total debts, although that number can be higher or lower based on your individual circumstances. That's the 30-second recap of what we discussed today. The simple summary of today's show is that every situation is different, so expert advice is required. But as Ted said, the monthly cost of a bankruptcy or a consumer proposal may be significantly less than the minimum payments you're making on your debts today. That's our show for today. For more information and full show notes, please go to our website at hoyes.com. That's HOYES.com. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.
If debt problems are keeping you up at night, if collection calls leave you afraid to answer the phone, it's time to end the cycle. You can do something about your debt. Call Hoyes Michalos today at 310-PLAN.